So we've got problem 8 and 9 here, and these are going to focus on involuntary conversions. We got Papaya. Papaya owns an office building destroyed by a tornado. At the time of the destruction, Papaya's adjusted basis in the office building was $400,000. The insurance company settled by making a $750,000 payment for the loss. So Papaya is going to receive $750,000 from the insurance as a result of this tornado. And by the way, we're going to assume that the office building is fully destroyed. It's not salvageable. It's fully destroyed. Make it a lot easier for us. 7 months after the tornado, Papaya acquires new equipment for one of the company plants for $90,000, and 2 months later, Papaya pays $705,000 for a new office building that qualifies as similar to the one that was destroyed. Assuming that Papaya wishes to minimize his income tax for the year of the loss. What is the realized gain or loss? The recognized gain or loss, the basis of the new equipment, and the basis of the new office building. Okay, so we're asked for 4 different things. We're going to go through all 4 of those. I'm going to label those. Now, one thing to note is that the question is telling us that Papaya wishes to minimize his income for the year. This is a hint that if there are any non-recognition rules or exclusions or deductions that apply, anything that reduces taxes, you need to take advantage of them. Okay? So, since we know it's a tornado, right, a natural disaster, if there is involuntary conversion, non-recognition, which only applies to gains, that means that Papaya wants to elect non-recognition. That's what that means. That's generally how my exams and the CPA exam and other professors, they hint that they want you to elect this provision. Because I don't want to just tell you, oh yeah, assuming Papaya elects 1033, because then it makes it clear that's what the issue is, right? So that's how we do that, okay? That's the wording we use. Assuming the taxpayer wishes to minimize tax for the year. So keep that in mind. Okay. So let's go ahead and start by calculating the realized gain or loss. Well, as we know, the realized gain or loss is the amount realized minus the adjusted basis. Amount realized is the actual cash received plus the constructive cash received plus the fair market value of non-cash property received minus selling expenses. Well, here, we've only got one of those, right? Papaya is getting $750,000 from the insurance company. So that's actual cash, $750,000. Now let me stop for a second. Let's remind ourselves, the event at issue here is the tornado. Tornado comes, goes down the road, boom, destroys the building, right? We got $750,000 within a few weeks or months when the insurance company pays. It pays as a result of that event. So the event, the involuntary event, is the tornado destroying the building. As a result of the event, the amount realized is $750,000 of actual cash, minus the adjusted basis of the property destroyed, $400,000 adjusted basis. That gives us a realized gain of $350,000. Now, another thing to note, let's put a little asterisk here at the $400,000. So some of you out there watching this video, you've probably taken other tax classes. You might recall casualty or theft losses. You might recall when you learn about casualty or theft losses, there's all these limitations, right? Individuals, 10% of AGI limit, which depending on the year might not be the case anymore. $100 or $500 floor, all these rules. Businesses and investment activity, they don't have to worry about those respective limitations. Well, since this is an office building and we're talking about the company and equipment, we're going to assume this is a business activity. It looks like a pretty reasonable assumption, right? Papaya has business activity here. So that's why we don't have any of these limitations to worry about with the $100 floor, $500 floor, 10% AGI. That's why we're not worrying about that. That's for individuals, right? Remember the big three activities? We've got business, investment, and personal use, right? Well, the personal use is the one that's most limited, and that's especially the case with casualty or theft losses where they have the additional limitations like 10% AGI and these floors. Now, another thing you might remember from the casualty or theft loss rules, you might remember that you have to, in determining the loss, you have to do the lesser of the fair market value change and the adjusted basis. That's true for personal. For business and investment, if it's fully destroyed, and that's why I had to note it's fully destroyed, we always use the basis regardless of the fair market value. So that's why I went right to basis, and I didn't even care about the fair market value change. We use the basis if we are a business or investment and it's fully destroyed. You don't even worry about the fair market value. If the fair market value of the building was less, if it was $200,000, we ignore it. We use the basis, $400,000, and subtracting away and determining the amount of the loss. Okay, so we got a $350,000 realized gain here. Okay, $350,000 realized gain. Now, the second question, the recognized gain or loss. Now, we've learned about involuntary conversions, section 1033, and we know that if there's a gain on natural disaster like a tornado or theft, shipwreck, eminent domain, seizure by the city state, which here we got again, natural disaster, involuntary event, involuntary conversion, we got the tornado. If we have a gain, we can elect non-recognition if we acquire property that's similar in service or use within 2 years. So here, Papaya gets $750,000. Papaya uses that money and buys $90,000 worth of equipment and $705,000 of a new office building. Now, some of you are looking at this and saying, wait, I thought it's $750. That equals $795. It does equal $795,000. So the idea here is something else is going on. $45,000 Papaya had to pay out of pocket economically. Now, if you look at the dates, 7 months after the tornado, Papaya bought the equipment. 2 months after that, Papaya bought the office building. So economically, it's more likely that Papaya uses $750,000 in order. But for tax purposes, this is very important. Please make sure you note this. The tax law is going to be preferential to the taxpayer. It's going to say that the qualifying property, which is this, right? The office building, that qualifies. The equipment does not because it's not similar in service or use, right? Because the office building is what's destroyed. Office building destroyed, you get $750,000. The office building proceeds to purchase the new office building, that qualifies for non-recognition because it's within 2 years, right? It's 9 months from the date of the event. But the equipment portion does not. The tax law is going to say the first, doesn't matter the order. The first amount goes to the qualified property and the rest, so here $40,000, sorry, my apologies, $45,000 goes to the non-qualified property. So that means that out of pocket, Papaya pays another $45,000 because $90,000 total. So with respect to the tax law, we use these numbers. 45 of the 750 goes towards the equipment. 705 of the 750 goes to the new office building. That's very important. By the way, the reason this makes a difference is because if we did it the opposite way, if we did it in chronological order, it'd be $90,000 of the 750 would be used for non-qualified, and then that would go into our lesser of rule. So again, we got the 705 office building, right, of the 750, and we've got the 45. So the rule is, right, if we elect, we're not going to recognize all 350, but it has to be lesser, right? It's the lesser of the realized gain. We calculate the realized gain is $350,000. Or the amount of the insurance proceeds not used on qualified property, which here again is $45,000. It's not $90,000. If you did it in the order that was actually used economically, it'd be $90, but this is actually $45 because again the tax loss arable. So the lesser of those two, of course, is $45,000. So the recognized gain is going to be $45,000. So that's step 2. Again, it's within 2 years. You're using the money on qualified property because it's similar in service or use, right? Office building for office building, but the non-qualified property does not qualify. So now we go to step 3 and step 4. Step 3 is real easy. Well, sorry, I should say the next part of the question. The next part of the question is asking for the adjusted basis of the equipment. For any non-qualified property, whether it's for like-kind or non-like-kind treatment, whether it's for the like-kind rules or for involuntary conversion, any non-qualified property that's not part of the like-kind or the similar in service or use, you're just going to use cost. Cost is going to be the basis. Well, Papaya spent $90,000 total, right? $90,000. So the basis of Papaya is $90,000. Okay. Now we go to number 4. It's the final part. Number 4 is to calculate the adjusted basis of the new office building. And remember, we use the shortcut method. What we do is we take the cost, which here is $705,000, and we subtract away the suspended gain, the gain that was not recorded. How do we get suspended gain? You might remember this from the like-kind exchange problems. We take step 1 minus step 2. So step 2 is $45,000. Step 1 is $350,000. We take number 1 minus number 2. So $350,000 minus $45,000. That is a $305,000 suspended gain. So we take $705,000 cost minus suspended gain of $305,000. That gives us a basis in the new office building of $400,000. $400,000. And we are done with problem 8. So again, we've gone through the realized gain or loss, the recognized gain or loss, the adjusted basis of the equipment, right, which is cost, and the adjusted basis of the new office building, which you take the cost minus suspended gain, which gives us $400,000 basis. You can't check your work, by the way, because we're using the suspended gain to actually get our basis here. Let's do problem 9. So this is what changes in problem 9. In problem 9, it's pretty much identical, except now Papaya only buys one asset. So at this point is where it changes. 9 months after the tornado, Papaya pays $800,000 for a new office building that qualifies as similar to the old one. Destroyed. So there's no equipment in this one. We don't have to worry about equipment. Okay? So now what we're going to do is we're going to go through the calculation again. Realized gain or loss. Recognized gain or loss. There's no adjusted basis of equipment. It's simply just the adjusted basis of the new office building. So we can go ahead and we can erase number 3 here. We don't have to worry about the adjusted basis of the equipment anymore, right? The costs, because that's not being acquired anymore. We can change number 4 to number 3 for purposes of problem 9. Okay. We can also erase our little diagram here, right? Let's see here. So what's going on is all $750,000 is being used on qualifying property. However, Papaya is paying an additional $50,000 out of pocket. Okay? So calculating our realized gain or loss is exactly the same. Look at this. It's still going to be $750,000, right? That's the amount that's received as a result of the tornado, $750,000. from problem 9 minus the basis. Basis is still $400,000. Hey, look at that. The realized gain or loss is still $350,000, just like in problem 8. Now we go to step 2, the recognized gain or loss. Well, guess what? We don't have any non-qualifying property, so the lesser of rule is no longer an issue because all of the money that was received in the insurance was used on qualified property. So the lesser of rule has now been completely wiped away. And look at this. Now, our recognized gain or loss is going to be 0 because it fully qualifies, right? It was all purchased within 2 years, similar in service or use, and all the proceeds were used. Guess what? That's going to be a suspended gain, a recognized gain or loss of 0, and a suspended gain of $350,000. Okay, that leaves us step 3, calculate the adjusted basis of the new office building. We'll take our cost. The cost here is not $705,000, it's $800,000. Let's just recalculate this whole, let's erase the whole thing here. Keep the formula the same. That is the same formula. Right, the cost is $800,000. That's what Papaya spent. Minus a suspended gain of $350,000. The basis is $450,000. And we are done with problem 8 and 9 dealing with involuntary conversions.